So now I switch to the English language because I would like to introduce our next speaker. And we are in the event of the CME Group Futures Trading Session. So that means we have a person from the CME Group, and I'm very proud to present you the Executive Director and the Chief Economist from the CME Group. I'm very proud that he's here, Mr. Erik Norland. Hi, Erik.
Hi, how are you? So sorry I showed up a few minutes early. I decided to put my camera on. I didn't realize it was going to show up for everybody too soon.
No, it's fine, it's fine. So in this case, I knew that you are here, so it's
Yes.
all good. Your topic is a very special one today because you want to talk about the management of volatility in the actual pandemic environment. So that sounds pretty interesting, and I'm pretty keen to hear what you will tell us. So let me give you the screen.
All right, very good.
And
there we go. I'm going to put on show my screen.
Yes, please.
Here we go. And are you seeing my screen? Is it coming through?
Yeah. Yes. So we see
good.
it's actually split it. I have on the left side the PowerPoint and on the right side some kind of text. Yeah, now it's the PowerPoint.
Okay, but let me go to slideshow mode. How does that look?
That is yes. Now we have it. Yeah, you're in the screen. That's pretty good. Thank you very much.
All right.
Here we are with Erik Norland. So enjoy.
All right. Well, thank you so much. Dankeschön. Unfortunately, I don't know a lot of German beyond Dankeschön. I've learned Swedish, French,
no problem.
Spanish, and Italian, but I'm planning to learn German one day. So someday soon. So before we really get into the presentation, I am required to show you both the short version as well as the longer and more detailed version of CME Group's disclaimer, which basically say that because CME Group is an exchange and not an investment bank or a broker dealer, we are unable to provide you with any financial advice. But with that in mind, though, I would like to take you through the presentation. And the world economy has been hit by this kind of enormous economic shock that has hit the markets, I think, very, very hard. And certainly the real economy very, very hard. But what I think is interesting, though, is that when you look at how the markets are pricing the next decade or so, they really are not expecting to have very strong economic growth. If you looked at the last decade, for example, we had very strong growth in dividends for the S&P 500. They grew 155% in the last decade. So far, our dividend futures show that there's really no expectation at all for, for any further growth in dividends this year, or for the rest of the decade even. So the market's beginning this decade with a kind of very modest expectation for what's likely to happen. There's no longer this sort of extreme expectation like we had earlier in the year that dividends are going to fall 40% or something like that. But there's just sort of this expectation that everything is kind of going to go sideways. And so I think that's a very, very unnerving thing for financial markets. If you look at the fixed income markets, you see kind of a similar story. The yield curve, which is a very strong indicator of how the economy will perform in the future, is also extremely flat by historical standards. You can see the yield curve in the blue line. Typically, at the beginning of economic expansions, you typically have a very strongly positive yield curve, maybe like a 4% difference or so between long-term bond yields and short-term bond yields. And that usually indicates that there's strong economic growth coming. This time you don't see that really at all. The yield curve is no longer inverted, but it's also not very positively sloped. So that's not, I don't think, a very good indicator for where the economy is going. If you look back at dividends, they haven't always been this flat. If you look back at 2017 and 2018, back then there was a strong sense that dividends were going to grow very, very strongly in the future. The dividends over the next 10 years were going to grow, perhaps by 50% or so over the course of the next decade. At the moment, there's no expectation for any further growth in dividend payments, which is strange, right? Because on the one hand, you have the stock market, which is trading at a very close to a record high in the United States. On the other hand, you have dividend payments, expected future dividends were actually lower today than they were 3 years ago when the stock market was, and the S&P was at 2,200 points rather than 3,600 points. So the market has gone up 50% in value, while at the same time, expected future dividends have actually gone down. So this is a very, very curious phenomenon. If you take these different dividend expectations, from the current year forward to 9 years forward, and you add them all together, and you compare them to the S&P 500, what you see is this graph here on the left. So in the black line, you have the non-adjusted value of the dividends. So just simply adding them all up from our annual dividend futures and comparing them with the blue line, the S&P 500. So here you can see the S&P 500 has gone up over 50%, but the expected future dividends has actually fallen. So you may ask yourself the question, why is it that the stock market could go up so much if people don't think that corporate earnings are going to grow strongly in the future, and they don't believe that corporations are going to pay out dividends to their shareholders that are any greater than what we've experienced in the last few years, and in fact could be less than what we've experienced in the past decade. And so the answer to that comes on this graph here on the right-hand side, where you look at the net present value of the next 10 years worth of dividends. And the net present value basically takes all these dividend payments, from the next year or the year after, 3 years from now, all the way up to 9 or 10 years from now, and it uses interest rates to discount those back into the present value. And so a large part of the reason why the stock market has continued to go higher is because interest rates have fallen. And so the decline in long-term interest rates explains almost the entire gain that we had in the stock market between 2017 and early this year. All of that was really because long-term interest rates were falling. That was increasing the value of future expected dividends in present value. And then when we had the sharp sell-off in March, in February and March, dividends, the net present value of dividends and the stock market fell together. But then what we've had since then is a complete decoupling. Even the net present value of future dividends cannot explain why the stock market has gone up to such a great degree. So why has the stock market continued to go higher, even if interest rates haven't declined, and even if the prospects for future economic growth don't seem to be very optimistic? Well, a lot of it, I think, has to do with two things. First of all, in response to the pandemic, we have had an enormous fiscal expansion. We have had a tremendous increase in budget deficits. The budget deficit in the United States at the end of last year was 5% of gross domestic product, which is already very, very high for an economic expansion. Currently, that budget deficit is 16% of gross domestic product, and that is without any further stimulus measures being enacted. It's likely that there will be further stimulus measures. Before the US election, there were 3 different plans that would expand that deficit by anywhere from another 2 to 10%. Now, of course, we've had the election in the United States, but the election outcome, I would say, is still a little bit uncertain in the sense that we don't know which party is going to control the United States Senate. If the Democrats have control of the Senate, it's likely that we will get more stimulus. If the Republicans keep control of the Senate, and there's 2 Senate races coming up on the 5th of January in Georgia, we may get rather less fiscal stimulus. But in any case, the stock market has really been inflated in value for the very simple reason that interest rates have come down to extremely low levels. If you look at the value of the stock market as a percentage of gross domestic product, you can see that it varies roughly inversely with the level of interest rates. When interest rates are very low, like they were, say, during the 1950s and 1960s, or like they have been for most of the past 25 years, the stock market can support very, very high levels of valuation. By contrast, when interest rates are extremely high, like they were during the 1970s and 1980s, the stock market tends to have much, much lower levels of valuation. And as you can see, the stock market has gone to a record level of valuation as a percentage of GDP, or at least the highest since the end of the 1920s, and certainly the highest since the end of the Second War. When you look at the stock market right now, it has about a 150% capitalization to GDP, which I think is quite remarkable given that the level of interest rates is so incredibly low. And so what this tells me is two things. It tells me, first of all, that fixed income is overvalued, that bonds are too expensive and the yields are too low. And then secondly, it tells me that stocks are also too high. And so I think this is what's making investors very, very nervous on a macroeconomic level. And what's been going on, I think that's driven the yields down so far is quantitative easing. All of the major central banks have been expanding their balance sheets to provide liquidity to the banking system and to the real economy. And so that's true of the Bank of Canada, the Federal Reserve, Bank of England, the European Central Bank, the Bank of Japan, as well as a number of banks I didn't put on the chart, like the Swiss National Bank. So in response to the pandemic, they have created enormous sums of money. And those enormous sums of money have been fueling a rally in the equity market. So if you're wondering why the equity market has decoupled both from the level of interest rates and from the level of future dividends, therefore decoupling from the net present value of future dividends, I think it's because of this monetary creation. This monetary creation has artificially flattened the yield curve. It has reduced the difference between short-term and long-term rates. If you look, say, in 2010 on the right-hand chart, when the Fed's balance sheet was much smaller, long-term interest rates were very high back then. They were, 30-year bonds were yielding around 4 or 5% in the early part of the recovery from the global financial crisis. Today, those same bonds are yielding about 1.7%. And so this creates a problem for the real economy too. In the real economy, in theory, corporations and households can borrow money to invest either through mortgage loans or through corporate bonds at a very, very cheap rate. But the problem is that corporations don't have a lot of confidence in the economy, so they're not investing. And the same thing is kind of true of households. Like in theory, you could have a very low mortgage rate, but unless you have exceptionally strong credit and people are willing to extend you, sorry, I didn't mean to stop sharing my screen. Let me see. I don't know what I did.
Oh, it's fine. I see your
That was fine.
PowerPoint.
Oh, you see the screen. Okay, I just seem to be seeing myself rather than the screen, but that's okay. I can still advance the slides. It's fine. So if you look at how the central banks have been expanding their balance sheet, what they've been doing is they've been mainly buying bonds, from the government, from corporations, from mortgages, et cetera. And in the case of the Federal Reserve, they did almost all of their buying in 3 months. They did almost all of that buying in March, April, and May. So when you look at the expansion of their balance sheet, it was really happening in a 3-month period where they bought $3 trillion worth of these bonds. But of course, nobody wants to be invested in the bond market anymore unless they absolutely have to be invested in the bond market because the yields are so low. So as bond yields came down, people were forced to invest elsewhere. And so they invested really in 3 places, I think. They invested really in silver, gold, and technology stocks. And so technology stocks, of course, was really, it was really mainly because they were seen as the winners of the pandemic. And since the Federal Reserve stopped expanding its balance sheet, we have seen that the rally in gold, silver, and the NASDAQ has come screeching to a halt. It's no longer going higher. And so I think the future of this rally in the NASDAQ that has taken the implied volatility up to such high levels on NASDAQ options, especially before the election, as well as created the put the volatility level of other markets like the S&P 500 at a more significant level, and also raise the value of gold and silver options above their historical norms. A lot of that, I think, is reflective of the Fed's balance sheet expansion and the nervousness that created that they might halt it. So now they've halted the balance sheet expansion. All of these assets have corrected. So implied volatility levels have relaxed a bit. The options market is not as nervous now as it was a few months ago. But nevertheless, I think the future of these trends really depends on what happens on the fiscal side in Washington and elsewhere. As I mentioned, we had the election, but the results in the Senate are still not clear. If we have another very large fiscal stimulus and the Federal Reserve steps in and buys that fiscal stimulus, then I think that sends things very, very much higher for gold, silver, and the NASDAQ. And in the short term, that's fine for the options markets, but as those assets go higher, people start getting nervous. They start getting nervous about the potential of a very abrupt correction in asset values. And the price of options typically goes higher. However, at the moment, though, it's not really clear if we're going to have that. And if we don't have another massive fiscal stimulus, then it's not clear what the central bank's going to buy because the government hasn't issued a great deal of extra debt. So we'll have to watch and see how that plays out. But this has been, I think, a very, very good time for gold. In particular, gold and U.S. Treasuries on a risk-adjusted basis have been doing extraordinarily well. So is the S&P 500. So the so-called risk parity strategy, where you essentially invest in treasuries that have been levered up to equity-like risk, alongside equities and gold, which has a similar risk to equities often. The sort of risk parity strategy has done very, very well. But the whole risk parity strategy is predicated on the central banks continuing to provide liquidity. And if the central banks stop expanding their balance sheet, then the possibility is you have a simultaneous correction in stocks, bonds, and gold. And the central banks won't tolerate that for very long. If they see asset values starting to come down all at once, they will probably step back in and start buying bonds again. And so the problem here is the central banks have found themselves in a trap. And the trap that the central banks are in is that they have to keep asset values high. Because if asset values start coming down, then a number of things happen. First, businesses lose confidence if they see the stock market crashing. Secondly, consumers, if they see the value of their investment portfolios going down and they start hearing negative stories about the financial markets, they could lose confidence and stop spending as much money. And if those two things happen, you have less investment, you have less spending, so you have a slower economic recovery. And so the central banks have found themselves in this trap where they don't want asset values to go up too high because they don't want to create a bubble, because that could eventually pop and damage the economy. But at the same time, they can't really tolerate these things coming back down in value because the economy is already very weak and they don't want to make it weaker. So they have themselves kind of in a pickle here. And that's why I think that gold is such a phenomenally interesting investment in this environment. It's such an interesting way to manage volatility in a broader portfolio that includes equities and bonds. Over a long period of time, gold has done about the same as stocks have in price terms. Now, this is a little unfair because gold does not pay dividends. Stocks do pay dividends. So if you include the dividends, the stock market's actually substantially better than gold on average. But there's some really interesting trends in these markets. If you look at various periods, there's been periods where stocks outperform gold over a few decades by 2,000, 3,000%. And then there's been decades in which gold outperformed the stock market by 1,000% or more, including during the 1930s and 1970s. And again, during this decade from the year 2000 until about 2011. And so, to my mind, when I look at this, I kind of get nervous and I think to myself, okay, the stock market's overvalued. The bond market's overvalued. Central banks are creating a lot of fiat currency, so they're creating a lot of euros, a lot of dollars, a lot of yen, and even other central banks that aren't doing quantitative easing, like the Russian central bank, for example, Brazil, they've lowered interest rates to record lows for their countries. And so there's a lot of monetary creation going on. Everybody's creating a lot of money. Everybody's running gigantic budget deficits. And you have to think to yourself, okay, so if stocks are overvalued, bonds are overvalued, huge monetary creation, debasing fiat currencies, well, who benefits? And I think the answer probably are things like gold and silver. So you've had this gigantic move in silver that took the implied volatility on silver options up to extremely high levels. Also had really big move in gold. The percentage move in silver was actually bigger. The ratio of silver to gold moved a great deal. And you can't print silver and gold. You have to mine it. And the mining supply of silver and gold has actually been falling in recent years. So the mines are producing a lot of it by historical standards, where they're producing less of it now than they were 3 or 5 years ago. And when it comes to mining supply, the mining supply of these metals has a negative relationship with price. If you have less gold and less silver being produced, typically you wind up with higher gold and silver prices, which is pretty logical. And so the mining supply is negative, is going down, so that's positive for gold and silver. And then the supply of fiat currency, whether it's the dollar, the euro, the yen, et cetera, is increasing. And as that increases, it decreases the value of those fiat currencies versus real assets. So I think it's really interesting to look at volatility in the precious metal space, and to expect that in the future, there could be very, very strong trends, in particular, if we see further fiscal stimulus coming out of governments, whether it's the government in Washington, D.C., or whether it's out of Brussels. Here in Europe, we had a recent stimulus regarding the Europe essentially issuing 700 billion euros worth of debt for the first time ever in common bonds. It's never been done before. And that may be the prelude to more coordinated fiscal action coming out of the euro area, which I think is also bullish for currencies or for gold and silver. I think it's also important to point out that high levels of debt are not a phenomenon that exists solely in Europe or the United States, also in China. We think of China as being the big outperformer so far during the pandemic. And indeed, their economy in many respects has done quite well compared to other economies. But I think that the Chinese economy has still suffered a great deal. It contracted 7% in the first quarter. The second quarter grew at 2%, and the third quarter grew at almost 5%. That's very slow by the standards of China. And to achieve that not very strong economic performance this year, they dramatically expanded their level of debt. Chinese companies went 18% of gross domestic product further in debt. Chinese household debt increased by 6% of GDP, and Chinese public debt, meaning government debt, increased by 6% of GDP. So all told, the Chinese debt level rose by 30% of GDP. It now exceeds that we see in the Western countries like the US and the countries of the Euro area. And so I think this bodes pretty poorly for China. In the case of China, they halted the internationalization of their currency. China has aspired now, I think, for many years to have a global reserve currency like the US dollar and like the euro. And this aspiration is understandable because a global reserve currency conveys power. Countries can use it to put sanctions on other countries, like the US is doing with Iran right now, to make their lives less convenient. It's a way of extending power, its prestige, but it comes at a cost. And so I'm sure one thing you've noticed in the US economy these past few decades is the US consistently runs enormous budget deficits. And those trade deficits. And that trade deficit's a reflection of the US dollar being the global reserve currency. So since the pandemic struck, the Chinese yuan has increased in value. Most other currencies have been falling versus the yuan. And the stronger currency in China is not good for China's exports. China's growth is below target. Their export markets are suffering very, very weak economic growth because of the pandemic, and China's currency is increasing in value. So this is not really the great environment for China. And so I think there's going to be a lot of volatility coming out of China in the next few years. And if you look at what's happening with the pandemic, you can see that we're suffering a very, very rapid rise in cases. So that's the bad news, but of course that's counterbalanced by the good news, which is a vaccine is on the way. So essentially, we have 3 vaccines. We have the Chinese vaccine, which is being tested in many countries, including Brazil. We have the Russian vaccine, which is being tested in Russia, but also in a few European countries like Hungary. And now we have this new vaccine from Pfizer, and there's many, many other vaccines coming onto the market. But so that's good sort of for the intermediate term. I think it creates a lot of upside risks that will need to be managed. We saw a huge increase in equity prices, particularly in the most beaten down sectors of the equity market, like small capitalization stocks, in the Russell 2000, for example. But at the same time, in the short term, we have this out of control pandemic that's spreading very rapidly through Western Europe and very, very rapidly also through the United States. It's just creating, I think, really big problems for the currency markets. I know this is really morbid, but if you take the mortality rate in the euro area and you subtract the mortality rate in the United States, what you see is a graph like this. And you can see the currencies have been moving, I think, a lot on the basis of relative mortality rates, which I know is something I never expected to talk about as an economist. But basically, when Europe was hit harder by the pandemic earlier this year, the euro sank in value versus the US dollar. Then as Europe seemed to get the pandemic under control in the spring and summer, whereas the US obviously did not, the euro rose very substantially against the US dollar because Europe reopened to a much greater extent than the United States did in the summer months. But now that it's spreading very badly here in Europe, worse than in the United States on a per capita basis, you're starting to see that reverse. And you also see, I think, a very similar phenomenon happening in the United Kingdom, where the pound had been stronger, but now the pound has 2 risks. It has the COVID risk, but it also has the additional risk of Brexit, which is why options on the British pound are substantially more expensive than those on the euro. And so you see this problem in China. China has gotten its infection more or less under control. They've only had a few deaths here and there in the last few months, and most of those have been people quarantining upon return from foreign countries. But the Chinese currency is very strong, so they've halted the internationalization of it for the moment because they don't want an overvalued currency that would damage the value of their exports. This is another big potential area of volatility. And then you have, very similar phenomenon for the Japanese yen. For emerging market currencies, it's kind of a similar story. Basically, the worse COVID has hit a given country, generally the worse the currency has performed relative to a commodity benchmark. And so a lot of these emerging market currencies, or not even all emerging markets, some like Australia, for example, Canada, they tend to follow commodity indices very well. And so Australia and Canada have not been so hard hit yet, although Canada is starting to be very hard hit yet. This graph I have here is slightly out of date. Canada's had a huge spike up in COVID mortality in the last few days. But when you look at countries like Russia, for example, that have been harder hit, Russia's really, the ruble's really underperforming. And the same thing is true of the South African rand and many other emerging market currencies, including the Brazilian real. So when it comes to sort of managing risk amid the pandemic, I think it's important to look at alternative sources of data. I think we spend a lot of time looking at major pieces of data being released by national governments here and there. But I think you have to be a little quicker now. And so one thing you can do is you can look at data, for example, from restaurants, on Open Table, for example, and you can see how quickly things shut down in Germany and the United Kingdom as they've gone back into lockdowns, or at least closed bars and restaurants, sort of a lockdown light anyway compared to what we had earlier this year. Whereas countries like Canada, the USA, and Mexico have kept them open. But COVID's spreading very rapidly there. So in the US now, you're hearing more and more talk about the US going back into lockdown, not on a national basis, but on a sort of state-by-state basis. And another thing you can do is you can look at the traveler numbers for airlines. The global airline industry is 10% of petrol consumption. And So the fact that travel is down so far is really, really bad news, I think, for the oil producers in particular. When you look at the level of oil inventories, they're very, very high now compared to where they were in previous years. You're seeing extremely high inventories of oil at a time when demand is very weak. And so the oil market was very stable over the course of the summer. Prices barely moved. They were in a very tight range, just above $40 per barrel for several months. And that's because I think the summer was easy for the oil producers. Yeah, the oil producers knew how much oil they needed to produce, and they had cut their production by 20%, so they started bringing inventory levels back down. But then things got much more challenging now because now demand is not constant like it was in July and August. It's now starting to vary a great deal more, and I think starting to go downward at a time when inventories are still quite high by historical levels, historical standards. So I think we're going to see a lot of volatility in those markets, and that's especially true at certain product markets in what's called ULSD, or ultra low sulfur diesel, formerly known as heating oil. That has extremely high levels of inventory. Ultra low sulfur diesel is sometimes a reflection of airline or jet fuel as well. And so it was hit very hard by the shutdown, or at least vast reduction in travel on the part of the global airline industry. And so I think that's also something to look at. And as I mentioned, oil producers are trying to cope with this. They've cut back production by 20%. That's true for Saudi Arabia. It's true for Russia after their springtime war. But 90% of the world's population lives in the northern hemisphere. And the biggest consumers are China, which seems to have pretty stable domestic consumption, followed by the United States and Europe, which have much less stable consumption. You also have other big northern hemisphere oil consumers, including Canada and Russia, where the virus unfortunately is spreading very, very quickly. So I think these next few months look like they're going to be really, really hard, and I think you have to keep on top of the economic data very carefully. So I think we have quite a lot of time left for questions or for discussion, and I'd be happy to keep talking.
Absolutely.
Yeah.
So it's very interesting what you said. Yeah? So, but what I see is, you said that during the spring and summer in Europe, where we were not hit by the pandemic, the euros goes up. The euro US dollar goes up, US dollar goes down. So that means from a nation who is exporting a lot of products, it's bad, because that will make the prices go higher for all the other countries which would import these products. So that means when we go into the lockdown right now, that is damaging the GDP, and in case it's getting a worse situation now in Europe, that means if will the euro comes down and it will help the economy, or that's my question to you.
Yeah, maybe. I mean, I think that since Europe is now in worse shape than the United States is, at least for the moment, that may change very quickly, by the way. But since Europe is in worse shape and is coming into another lockdown, at least sort of a lighter version of lockdown coming to the United Kingdom, France, Italy, Spain, Germany, other countries as well, that is, yeah, I think that's bad for the euro. I think the euro has been a little bit supported in recent weeks by the uncertainty surrounding the US election, whereas, the president has not conceded defeat. He's continuing to mount legal challenges. We have the uncertainty over the US Senate. And so there's a lot of kind of unease in terms of the feel in the United States. It's probably also helping to keep the euro at a higher level than it might be otherwise. But if the election uncertainty clears up, the euro might come down a little bit, and that I think would be beneficial to Europe on a small scale.
What I mean.
When it comes, oh, sorry, yeah, go ahead.
No, that's what I mean. That it's beneficial for the European economy if the euro comes down a bit.
Yeah, and I think it depends on the country too. I mean, different countries in Europe are affected differently by the currency. And the reason why that is that Germany, on the one hand, produces what economists call highly differentiated products. So Germany exports a lot of products that simply can't be produced in many other countries. I mean, Germany's main competition in terms of creating industrial equipment is probably really China and Japan.
Okay.
Although Germany sells a lot of industrial equipment to China. Where other countries in Europe produce much less differentiated products, products that are much more like what's produced around the rest of the world. So countries like Italy, Spain, and France, I think, have a greater sensitivity to movements into currency than Germany does. So not only could it lower GDP growth, but it could lower GDP growth in a rather uneven fashion, hurting some countries more than others if the currency becomes too high, or maybe helping some countries more than others if the currency goes back down. But I think the problem, though, around the world is all the central banks are trying to devalue their currency simultaneously, and they can't all do that at once against each other, but they can do it against gold and silver.
That's interesting part. Yeah, very good. So on the other hand, the airlines are very low. So we are almost about 30% on average on the flights that we had before the pandemic. And the travel industry is very low. What can we expect there? Will that be getting better in the next year or so?
Well, I think in the next year, I believe it will get vastly better in the next year. So I think in the short term, the outlook is very, very negative because of the spread of the coronavirus. I think that, essentially this year in the United States, Thanksgiving travel is canceled. Christmas travel is canceled for the entire world. New Year's travel is canceled for the entire world. And I don't think there's going to be any business travel in the first quarter. And so business travel is really the bread and butter of the airlines. It's where they make the money by filling up those expensive seats at the front of the plane. However, as I understand it, and my understanding is not perfect, but my understanding is that this vaccine becomes available at the very end of November or early December. It will first be given probably to medical practitioners, so doctors will get it first. That will be followed by the most vulnerable people, so presumably elderly people or people with pre-existing conditions that make them especially vulnerable to the virus. My understanding is it will become widely available for everybody, for people like you and me, to have it probably between the months of April and July. And so I think that by the time we get to November next year, the world will have gotten very, very substantially back to normal. And I think that the appetite for travel after that's a little bit unpredictable. And on one hand, you could have a situation where people have saved up a lot of money because they haven't been able to spend. So they all decide to go out and travel. So that maybe you could see a huge rebound in travel. On the other hand, you have people like myself who used to travel a lot, but now have become accustomed to doing events online, which saves a lot of money. It saves a lot of time. I don't have to travel so much anymore. I don't get jet lagged, and it saves my company a huge amount of money not to send me around the world anymore. So it may be that business travel never really recovers, but you do see a lot more vacation travel. So you may see a very uneven recovery in the travel industry after this, where certain aspects of it, like vacation and leisure and things that appeal to people who have income. I think in terms of who got hurt in this pandemic, the people who've been hurt by it the worst are people who have to be physically present at their jobs. So and people like those of us on this call, presumably all of us, who can telecommute to work, who can work from home, a lot of us have been saving a lot of money. So some of these higher end vacation things could do quite well. But I think the travel industry will recover very sharply, but it will recover very unevenly, and it's going to look different afterwards than before.
Okay. Okay, I have a question from the audience. Hi, Eric. How do you see Brexit playing out? Outlook for cable?
Oh yeah, so that's a really good question. So Brexit is the ever-moving deadline. There was a deadline, I think it was on July 15, and then it became October 15. Now it's next week. Next week is the new deadline, which will almost certainly be shifted. And I think that Brexit, to my mind, this is my own personal opinion, was never a particularly great idea for the UK and was always going to be a problem. Because the UK still has to obey a lot of European rules, but now they're no longer be a member, so they don't have any say in how those rules are being decided. And then you put the pandemic on top of that, And I think it's in a really difficult situation. The UK economy, like everybody else, is very distressed by the pandemic. The UK is actually one of the hardest hit countries in the world on a per capita basis, worse than the United States and worse than most countries on a continent. Um, and so you kind of layered Brexit on top of that. And I think it's creating a lot of stress here in the UK. The economy is already not strong, so then you kind of add the potential for a big disruption on top of something that's already disruptive, and it's not very easy. Um, and so what I've noticed in the last day or two is there's been a lot of movement in Boris Johnson's cabinet. First, one of his press secretary kind of got shoved out over the weekend, and then his number one aide, Dominic Cummings, who was one of the architects or sort of the mastermind, if you will, of the Brexit campaign, has also been forced out. To my mind, this signals a shift that the UK is getting ready to throw the hardcore Brexiteers overboard, and that they are getting ready to do something. And so this something is probably, to my mind, more likely to be bullish for the pound. It could be that they just agree to whatever the EU puts in front of them, they sign it, move on, and there's very little trade friction afterwards. Or it could be that that they extend past the end of January and say, "Oh, we need more time to think about this."
Okay.
But I think that Dominic Cummings' departure and the departure of other top-level Brexiteers is probably on balance bullish for the pound. The pound has always sold off these last few years in any kind of move towards a hard Brexit, and it's always rallied towards a move towards a softer Brexit or an extension. So I tend to think the pound might be an outperformer here, but I could be wrong.
Okay. What do you think about the seigniorage capital of the Eurozone in connection with the increase of the M1 money supply?
So I didn't get the first part of that question.
Do you think about the seigniorage capital? Peter,
Oh
what
yeah,
do you mean with it?
yeah. I don't really know. I mean, I think that the ECB's expansion of the money supply has really been offsetting a decline in credit extension. Um, and it's also been using to fund government budget deficits, which it's not really supposed to do, but it has to do it because otherwise the economy will collapse. Um,
Okay.
and so I think that the ECB's creation of money in general is bullish for asset prices. And that asset price could be equities, it could be gold and silver, it could be land. I think land values outside of big cities are soaring. And so I think that the money has to go somewhere. So it first goes in the bond market, but then the question is, where does it spill out over to? And it can spill out into many, many different places.
Ah, okay. He meant the whole GDP from the EU zone, yeah. So with this capital.
Yeah. Yeah, I mean,
Okay.
I think that it is helpful to GDP in the sense that it prevents it from collapsing. Like it prevents something like the 1930s from occurring. But by itself, it can't cause the economy to grow. Um, but it can prevent the economy from collapsing. So it's more of like a downside protection. It's more like the ECB essentially is giving everybody a put option.
Ah, okay. Oh, very interesting. What do you think about inflation in the future? That's a good question. Yeah. So we don't see any inflation depending on the high deficits, or that's the
Well, so
reason.
I would argue that we've seen a huge amount of inflation in the last several months. So the huge amount of inflation we've seen has been in equity markets, in gold and silver, but it has not really
In
been in
terms of
consumer
the asset
prices.
prices that they going higher, you mean?
Yeah, and so to my mind,
Or of asset
so
prices.
yeah. So to my mind, the idea that we have a lot of consumer price inflation is something that people have been afraid of for a long time, and it keeps not happening. The ECB expanded its balance sheet a great deal over the last 10 years, and it could not even achieve its inflation target of 2%. Um, and so I think people don't understand exactly what's happened in our economy. So the way I explain it as briefly as I can is this, is
Okay.
that back in the 1970s and 1980s, when we had much higher levels of inflation than we have now, we had a
Mhm.
much more equal economy. So the difference between the rich, the high earners, and the low earners was not so great. Um, However, In these last few decades, that gap has widened enormously. And it's widened, I think, for a variety of reasons. It's widened in part because the Soviet Union collapsed, and so a lot of these workers in the former Soviet Union are now competing with Western workers for jobs.
Okay.
It's true because China, over a fifth of the world's population has gone from being isolated under Mao Zedong to being integrated into the global labor market. Similar story for India. People forget about India, but India in the 30 years after independence was very sort of isolated economically. They wanted to do everything locally, but now India is integrating into the global economy too. So this has caused wages to go sideways. At the same time, rapidly advancing technology has caused productivity to go up. And so what that did is it took all the benefits of this growth and it gave it to the owners of capital. It's been the people at the top that benefited the most from this economic growth, where people lower down didn't see the benefits. And so you cannot have consumer price inflation unless you have strong growth in wages. And we have not had strong growth in wages for a long time. And in particular, right now, the labor market is a disaster. I mean, in the US, we have very high unemployment because of the pandemic. In Europe, the unemployment is disguised because governments are paying companies to keep workers who are not really working on the payroll. But we've seen huge advances in technology happening because of the pandemic, like the call that we're on right now through a webinar, which is not what we would have been doing, I don't think, if the pandemic had not struck. This is cutting out a lot of middlemen. It's cutting out a lot of employment. So I think the employment market remains weak for many, many years. That means that we don't have much consumer price inflation. But bear in mind that when central banks create money, it always creates inflation. The kind is what kind of inflation? If it's not going to create consumer price inflation, it's going to create asset price inflation. And so
That's
what
what I
we've
meant.
seen is
Okay.
asset prices inflating.
Okay, yeah, that's what I meant, because it compensates the consumer inflation, and it will take the asset prices much higher, and then we have an inflation in the assets. That's exactly what I thought is the case.
Yeah.
Okay, great, thank you. Next question I have from the audience: do you expect a change in economy politics by Biden, by the new US president? How can I profit as a shareholder from it?
Mm. Well, that's a really good question. I mean, I think that Joe Biden is somebody who's sort of a moderate Democrat. He's a lot like Bill Clinton or Barack Obama in terms of his outlook. He's not a radical socialist. I don't think that even if he could, I don't think he would really take tremendous steps to change the way the U.S. economy works. I do, however, think there will be some subtle changes. So, one thing that did very well when Trump was elected was highly regulated industries, in particular banks, oil companies, industrial concerns that maybe produce pollution as a byproduct of their manufacturing activities. All of these kinds of stocks did really well because the idea was that Trump was going to come in and he was going to reduce regulations, which he did. And now that Biden's coming in, I think he's going to put in people who are going to be a bit more stringent in their enforcement of environmental and financial services regulations. And so that may have an impact on those areas of the stock market. There's also some nervousness too in technology companies that a lot of these big tech monopolies like Facebook and Google, et cetera, may find themselves under increased regulatory scrutiny, and maybe asked to break up or divest themselves of certain businesses. But I think though that what's going to limit this is the fact that Biden does not have a firm control of Congress. He was not elected on a blue wave. The Democrats lost seats in the House of Representatives, and now we'll have a tiny majority, probably something like 223 seats to 212, which is not very big. And I don't think they're likely to have a majority in the Senate. There are these two races in Georgia. If the Democrats win both of them, they'll have a 51-50 control of the Senate. If they lose both, the Republicans have a 52-48 control, which means that basically no legislation gets through without compromise. And so I don't think there's going to be a big regulatory agenda. But I'll tell you what makes me the most nervous about this. My belief is as an economist, is that the U.S. economy requires massive fiscal stimulus. because there are so many people who are facing eviction from their homes. They cannot pay their mortgages. There's a lot of problems out there. So I think the US needs trillions of dollars in additional fiscal stimulus for its economy to pull out of this strongly. And if there's no agreement in Washington, that creates a really bad situation. And I think if there's no fiscal stimulus, the place to be is actually long-term government bonds. 10, 20, 30-year government bonds are going to be the things that go way up in value if the economy doesn't come out of this strong. And they may actually do better on a risk-adjusted basis in gold and silver or the equity market if there's no fiscal stimulus.
Okay, and that was some kind of graphs you showed us in the presentation where we saw the different plans from the different sides on the deficit spending in the future before the election. You saw the Senate and the president, and it was a very good graph. I liked it. So it's just what you explained.
Yeah.
How do you see the cryptos, especially Bitcoin, compared to gold and silver? Are there also winners of this? Because you told us gold and silver is maybe a good investment in these times.
Right. Well, I think the cryptos have been doing very, very well, in particular Bitcoin. And I mentioned, it's the same reason, but it's even stronger in the case of Bitcoin, which is in the sense that gold supply expands every year by about maybe 1 to 2% based on the previous stock of gold. Like if you took out all the gold that's ever been mined, and you take the new gold that was mined in 2020, it would expand that supply by about 1 or 2%. Bitcoin supply is perfectly inelastic. It does not matter where the price goes. No more of it will ever be produced than the algorithm will allow. And the algorithm that produces it is slowing down the production of new Bitcoin. So we had what's called the halvening recently, where they halve the rate of production. And there's another halvening that occurs in 4 years, and you get up to an asymptotic limit of 21 million coins, and that's all the coins that will ever be. And that's not true for gold and silver. Gold and silver is as much as we can get out of the Earth crust, or maybe out of the moon or asteroids. That's how much we can eventually have. But with Bitcoin, it's fixed, and so Bitcoin, I think, has been a big beneficiary of this move towards stimulus and move towards quantitative easing. But it can also be a victim if no further stimulus arrives and the Federal Reserve pulls back on quantitative easing. So it's not don't think of it as a one-way street. Bitcoin, as we know, is just mind-bogglingly volatile.
Very good. Thank you very much, Erik Norland, the executive director from the CME Group, chief economist. So I enjoyed your speech and all the things that you said and told us. So it was very, very interesting. Your side of the management of volatility in this highly pandemic environment. So it's a little bit tricky for all of us, and we will see how it goes out. But thank you very much for this speech.
Thank you. Thank you so much for inviting me. It was really a pleasure.